In the early 2000s, investors lost billions of dollars because corporate governance failed, and investors lost confidence and trust in the financial statements of publicly traded companies. High-profile scandals showed ongoing and significant manipulation of financial statements, and one of the reasons was weak oversight and insufficient regulations to prevent such widespread misconduct. Prior to SOX, rules like the Foreign Corrupt Practices Act of 1977 mandated internal controls, and the Treadway Commission's COSO framework of 1985 provided voluntary guidelines for internal controls. What was needed were stricter and enforceable financial reporting requirements and accountability, along with existing GAAP standards, as well as additional oversight via the PCAOB to ensure adherence. Like the saying goes, a rule with sharp teeth. Today, we'll look at SOX not as a list of sections to memorize, but as a response to corporate ethical and governance failures, and as a reminder of what happens when governance, oversight, and accountability fail. And to understand Sarbanes-Oxley, we first need to understand the problem it was trying to fix. Sarbanes-Oxley exists because multiple layers of oversight failed at the same time: management, boards, auditors, and regulators. This was not about a few bad journal entries or account reconciliations. It was about systematic failures that allowed unethical behavior to continue unchecked. Let's go through how the failures showed up at Enron. For instance, Enron used complex special purpose entities to keep debt off its balance sheets, making the company appear more profitable and financially sound than it was. They artificially boosted revenues through mark-to-market accounting and risky off-balance sheet deals, especially in their broadband division. Executives like CFO Andrew Fastow profited personally from the complex partnerships while misleading investors. As Enron's auditor, Arthur Andersen improved Enron's fraudulent financial statements, failing to uphold its duty to investors. And Andersen earned significant consulting fees from Enron, compromising its independence and ability to challenge Enron's accounting. The firm famously ordered the shredding of Enron-related documents, leading to a conviction for obstruction of justice, later overturned, but the damage was done. Enron's board of directors failed to exercise due diligence, ignoring red flags about high-risk accounting and undisclosed off-balance sheet entities, and prioritized personal financial gain like stock sales over their fiduciary duty to shareholders. The SEC didn't adequately review Enron's annual reports or challenge the aggressive accounting methods it allowed, although Vice President Sharon Watkins raised concerns about the accounting practices as early as 1996. But the issues weren't fully pursued or addressed by the firm or regulators. Interestingly, the M-score calculation developed by Professor Benage at Indiana University is deemed an indicator of financial statement manipulation and flagged up Enron as an earnings manipulator before the scandal broke. SOX fundamentally changed expectations around who is responsible for financial integrity. It made ethical accountability explicit and enforceable. Executives must personally certify financial statements, and ethical responsibility can no longer be delegated. I didn't know is no longer a defense. Internal controls are not just operational tools, they are ethical safeguards. And management must assess internal controls, and weak controls are synonymous with ethical and financial risk. SOX assumes that good intentions are not enough. SOX sections 301, 406, and 806 are about creating environments where concerns can be raised, not suppressed. SOX also sends a clear message: ethical misconduct and financial reporting is not just unethical, it's criminal. Section 802 specifies criminal penalties for document destruction and fines in prison for knowing misrepresentation. That means that ethical failure now has legal consequences. SOX also mandates rotation for lead and concurrent audit partners every 5 years, with a 5-year cooling off period in Section 203, and restricts most non-audit like consulting services to their audit clients in Section 201 to prevent conflicts of interest and ensure independence. Let's look closer at the penalties, though. SOX holds top executives, CEOs, and CFOs accountable for certifying that financial reports are correct, valid, and satisfy SEC disclosure requirements. Executives are personally and legally responsible for this written statement that verifies financial disclosures. Being personally responsible means that you vouch for the accuracy with your personal assets. That's important to know because many corporations ask managers and directors to also sign SOX sub-certifications. Knowingly submitting a report that does not meet SOX requirements may result in a $1 million fine or prison time up to 10 years. This is the penalty for cases where company executives know that their financial report doesn't meet the requirements, but they sign a written statement anyway. Willfully certifying a report that does not meet SOX requirements can result in a fine of $5 million or up to 20 years in prison. In terms of altering and destroying records, violators who knowingly alter, destroy, hide, or falsify records, documents, or tangible objects to interfere with a federal investigation or a bankruptcy case can face up to 20 years of imprisonment, fines, or both. Companies that fail to comply risk being delisted from the public stock exchanges and up to $25 million in corporate fines. These sanctions impact a company's reputation and could limit the company's stock market activities. CEOs and CFOs risk being barred from leading any publicly traded company for multiple years. These fines might seem severe, but one could argue that these penalties are not severe enough. I've worked for large corporations, and many leadership teams evaluate the price of non-compliance. Especially very large corporations might not view a $25 million fine as a big deal, especially when the cost of compliance is more expensive. I'd argue that if the penalty was equal to the amount of the fraud, it would have more bite to it. Diamond Foods is a reminder that Sarbanes-Oxley did not eliminate accounting fraud, but it did increase the consequences. Founded in 1912 as Diamond of California, the company became publicly traded in 2005 and grew into a global snack food producer with brands such as Kettle Chips and Emerald Nuts. Under CEO Michael Mendes, Diamond Foods embraced a bigger is better growth strategy. Facing intense competition, Diamond Foods pursued aggressive expansion, including acquiring Pop Secret popcorn and attempting a $1 billion purchase of Pringles from Procter & Gamble. The Pringles acquisition would have made Diamond Foods the second largest snack food distributor in the United States, creating significant pressure to boost earnings and market share, conditions that may have encouraged unethical behavior. Former employees and board members reported strong pressure to meet ambitious earnings targets, which triggered large executive bonuses. Between 2009 and 2011, Mendes earned approximately $2.6 million in bonuses for exceeding EPS goals and publicly promised sustained EPS growth of 15 to 20%. In 2011, concerns emerged when analyst Mark Roberts alleged Diamond Foods improperly recorded momentum payments to walnut growers, shifting costs from fiscal 2011 into future periods. Management initially denied wrongdoing, claiming the payments related to future crops. Investigations later found that these payments were used to inflate reported earnings, with CEO Michael Mendes and CFO Stephen Neal improperly accounting for grower payments, including approximately $20 million in misclassified continuity payments. The resulting scrutiny halted the Pringles acquisition, delayed financial filings, and damaged relationships with suppliers, investors, and regulators. The scandal led to significant financial and reputational harm. Diamond Foods paid $5 million to settle SEC fraud allegations, while Mendes forfeited $4 million in bonuses and paid a civil penalty. CFO Steve Neal also settled SEC charges. In addition, the company paid $100 million to settle investor lawsuits alleging misleading financial reporting. Overall, the Diamond Foods case underscores the importance of strong internal controls and effective oversight by management, boards, and auditors. The fraud triangle, opportunity, pressure, and rationalization helps explain how the accounting fraud at Diamond Foods occurred. Opportunity existed because internal controls were weak or not enforced, and management failed to set an ethical tone at the top. In fact, investigations suggest that senior executives themselves engaged in unethical behavior, further enabling fraud. The CFO's position on the board also reduced oversight. Pressure was significant. Diamond Foods faced intense incentives to improve performance, including boosting EPS to acquire the Pringles brand, comply with the debt covenants, and generate large executive bonuses. A highly competitive industry and corporate culture increased the pressure to succeed at any cost. Finally, rationalization likely occurred when management denied that the momentum payments were improper. After the irregularities were uncovered, executives claimed the payments were made to optimize cash flow for growers, rather than to shift expenses between periods. Weak controls and a poor reporting environment may have dispersed responsibility across the organization, allowing individuals to deny wrongdoing and rationalize their actions. One important takeaway is that Sarbanes-Oxley has achieved significant change, and penalties for noncompliance are significant, although not always easy to prove. Prosecutors often prefer easier civil cases or other charges like obstruction, and limited resources and a culture that sometimes protects powerful figures may hinder criminal prosecution. The focus shifts from individual CEOs to corporate settlements, and proving executives knowingly signed off on false financials rather than just being negligent is more difficult to prove. Nonetheless, SOX is still very much relevant because it restored investor confidence, created a framework for corporate governance, mandated strong internal controls, and holds executives and corporations accountable.